Hello and welcome to Indianomics. I'm Latha Venkatesh. The Indian Rupee has just done a U-turn. After falling by nearly 4% from November 24 to February, the Indian currency is up 1% in the past week and up 2% from its February 10th lows of 87.95 per dollar. One big reason for the rupee's recovery appears to be the February trade data, which showed a monthly trade surplus if you took goods and services together. Now, foreign portfolio outflows, especially on the equity front, have begun to thin down, but they still remain outflows. Has the rupee bottomed? Will India's current account deficit remain contained next year as well when tariffs loom? Will the net capital outflows turn into capital inflows in this calendar year? Now, that will also depend on India's growth trajectory. For a 360-degree perspective of growth, rupee and rates, I have with me an elite panel of economists, Samiran Chakrabarty of Citibank, Santanu Sengupta of Goldman Sachs, and Upasna Chachra of Morgan Stanley. Gentlemen and Upasna, thank you very much for your time. Samiran, let me start with you. You are quite convinced that this quarter, Jan, Feb, March, we will post a current account surplus?
Yes, Latha, that has been the trend for a while now in the last few years, when we are seeing this seasonal improvement in the current account for this fourth quarter of the fiscal year. So we think that that same trend will continue this year as well, and we should report a current account surplus for this quarter.
Okay. Santanu, what is your sense about this quarter? And more importantly, whether the deficit will remain contained in the coming quarter as well? Your thoughts?
Yeah, I would think that, as Samiran said, that, in the last couple of years, you've had this trend of this particular quarter driving into a current account surplus. So likely you will have this in this quarter, but going forward, you'll have some expansion of the deficit. We still think that the external balances from the current account side is going to be relatively comfortable. You're still going to have a strong amount of services exports coming through. Your remittance inflows are good. So we would think that the current account deficit will be contained within 1% of GDP, probably a shade lower than 1% of GDP.
Okay. Upasna, the more difficult question has been capital flows. Y'all came out with a strong report on Indian equities and Indian growth. Is there any internal estimate on whether the capital outflows will thin out and we may turn to inflows? If yes, when?
That's really a tough question to answer in terms of how capital flows can change. But I think at the margin, what we are sensing is that, and as you also pointed out from the data, that probably some amount of the bearishness from an equity investment perspective is finding a floor. There's more recognition that data is not deteriorating and at the margin improving for India macros, and policy is also moving in direction to support growth. So again, as you highlighted, the growth delta matters for India from a capital flows perspective. And I think there is reason to believe that the second half probably could be somewhere where we would see that growth delta, looking better for India versus maybe other economies as well. And that could turn the capital flows picture as well for India.
Okay. No, I agree that the toughest question was for you. I mean, it's a difficult one to guess. But Samiran, would you, I think in your recent report, you have upped your forecast of rupee. Can you take us through your argument? You believe the rupee is now in a stronger patch than what you perceived a couple of months back?
So a few things have happened, Latha. One is that overall, the DXY itself has come down quite substantially from around 108, 109 levels to more like 103, 104 levels now. The second is that because we had allowed a bit of currency depreciation, nominal depreciation, and the fact that our inflation has corrected very sharply has led to the overall 40-country INR RER now back to around the 102 mark, which is slightly lower than even what longer term average has been on RER. So from a valuation perspective, rupee has moved into a much more fair valuation level than what it was even a few months back. And on top of it, this improvement in current account, the seasonal improvement in current account, and we are also hopeful that at some point of time, the capital flow picture will also improve, not just because of the portfolio flows turning, but also because the FDI repatriation outflow that we have seen being massive over the last couple of years, at some point of time, that will stop. So we are hopeful that for FY26, the net FDI number will look better than what it has been in the last couple of years. We're not yet expecting it to go back to historical trends, but at least some improvement on that front, along with a pickup in the portfolio equity flow, should make the current account look somewhat better, which could also be supportive of rupee. And last but not the least, Citi has a view that oil prices will come off quite materially in 2025, maybe even going towards $60 per barrel by end of the year. That will also be quite supportive for the currency.
Okay, so what's your currency range now, Samiran, as of March end, of course, which is just a few days away, and for year end?
So, I mean, the way to think about it is not just from a rupee dollar level, but from a more relative perspective. So the argument that I was giving was more of a relative argument. But we think that as the tariff picture becomes clearer after the reciprocal tariffs are introduced next month, we could see some retracement in dollar also going towards DXY, going towards 106 and all. So with that, maybe rupee also can move towards 87, 88 range. But compared to the relative nominal depreciation that we had seen in the last few months, I think that's behind us. The key challenge for RBI would remain that this very large forward book that it has got, how it brings it down to a more normal level. So as and when the BOP situation improves, that will be, in my view, the primary objective of the RBI. The spot reserves are okay for now. That's enough for them to be able to control the currency in a narrow range.
Okay. Well, according to what dealers tell us, even at the moment, RBI is allowing the swap, the sell swaps, and they're selling, but they're buying more than they're selling. So it's a net buy figure, which we have even for last week. And of course, there is this buy-sell swaps, which they have pushed 3 years down the line. Maybe we will get more of that. Santanu, what is your sense in terms of where the dollar rupee can go by the end of the year? I know it's a little unfair given the tariff, overhang, but nevertheless, how much of a depreciation this year?
Yeah, and end of the year, Latha, is a long time out.
Yes.
With so much of uncertainty around. But we would think that in the near term of around the 3-month horizon, you hover around this 86.5 to 87.5 kind of a mark, and get towards an 88 over a 3 to 6 month kind of horizon. In the long term, we have right now baked in a depreciation of around 2.5% odd, which takes you towards that 88, 89 kind of mark. A lot of uncertainties, obviously, regarding flows, not so much the current account side, but more on the capital account. I would just emphasize the point that the short forward book position that the RBI has is quite sizable, and therefore, whatever inflows you're getting through the course of the year, and the role that you use in the forward book will be important in terms of the currency management. And again, from a spot reserves perspective, while you're looking comfortable, right now the respite that you're seeing in the rupee is also largely because the dollar has turned, and therefore your short positions that were the positioning that we're building up offshore has also probably lightened up. And it is therefore going to be the dollar trajectory which is going to matter for the dollar rupee pair in particular. But over the medium term, again, going back to the fundamentals, the current account looks very comfortable. If some of the flows are back, the RBI should be able to manage it, and you're not going to have the requirement for a large depreciation that you had in the previous 3 months, because your vol is right now much higher than what you had in the second half of last year. So the vol adjustment will also be lower through the course of this year.
No, I take your point that the Reserve Bank's NDF sell position, the forward sell position is overhang, as both you and Samiran point out. But there are these other positives, and perhaps the Reserve Bank will have some elbow room to kick that forward, as they have done with $20 billion of swaps. Upasna, your rupee view.
So in the near term, I would say it remains more range bound, of course, begging more clarity from the trade policy that we see on 2nd April. Beyond that, I think, as both Samiran and Shantanu have pointed out, it will depend on the DXY positioning as well. We do have a slight depreciation bias if I have to take the 9 to 12 month view, also in line with what we think probably the CNY could see in terms of some depreciation further in calendar year 25. And that could play a role as well. But the dynamics of the BOP probably are going to be more supportive, as are the inflation differentials. And again, from the worst in terms of the rupee is probably behind us, is how I view it as well.
Okay. So would you all go beyond the 88? The maximum I heard here is Santanu saying at the most 89. At the height of the rupee depreciation, people were talking about 90 very freely. Now, even at the end of the year, you guys are only looking at 89. Upasna, what is the in-house view in Morgan Stanley, even if that's not your terrain? What are people talking about, 88 or 89 in the current year?
So for us, the peak for USD INR does go to 89. Yes, we don't go past that. And that's more like, 6 months out.
Okay. No, I agree that these days calling so far out, as Santanu said, is difficult. But yes, considering where we came from on the rupee, this even at 89, this will be less than a 2% depreciation. And from the height of 87.95, it is only a 1% depreciation, which is low by our historical standards of an average of 3% per month. But let me also get a quick growth view. Ultimately, the rupee was weakening also because, or the capital outflows happened also because India's growth picture dulled last year. Samiran, let me start with you. What's your sense? Will this year, will Q4 show a substantially better growth? The Mospi's arithmetic is 7.6, but where may we end up?
So, Latha, it's not probably fair to extrapolate the Mosby numbers for the fourth quarter, because we will see revisions to the first quarter and second quarter numbers as well. So you could still end up with the full year being close to 6.5%, but the fourth quarter not being at that extrapolated 7.5%. We think that we are, whatever high frequency data we have got for the fourth quarter, it appears to be tracking closer to 6.5 as yet. And then that is an improvement from the quarter before, from the 5.4, which was the September quarter bottom. So we are on that path of improvement for sure. In terms of the drivers, I would say that the rural is still holding up quite okay. Urban is gradually improving. Investment side, public investment, some improvement. Private investment yet to show any significant pickup. Now, on top of all of this, there will be two factors to really watch out for. One is if the equity market improves, then all the consumer side measures taken by tax cuts and rate cuts, they will kick in and give you the big thrust for next year. And the second, on the opposite side, is to what extent this global uncertainty persists, which will keep on private investment depressed and become a headwind for growth. I think these are the two opposing factors that we have to track for FY26 to get a better idea of whether where we are going to land up.
Okay, so you're 6.5 for the current quarter, and what is the working number for FY26?
We're at 6.6, a very similar kind of number.
Okay, but that's still a little better than many other forecasts. Santanu, where do you stand on Q4 itself? If I remember right, you have a report upping your growth forecast.
Yeah, that was about a couple of months back, where it was a shade higher, almost marking to market in terms of data.
Okay.
Look, over the medium term, we firstly on Q4, we are at 6.7. And I think, it's exactly because of the reasons that Samiran mentioned, this is not probably fair to compare what the extrapolated CSO number would be. But I think more broadly on the growth cycle, we remain still below consensus at 6.3% year over year for fiscal 26. And the main reason is because that we think that the worst in terms of the growth numbers, showing up is over. So 5.4 clearly was the bottom that you got to see in Q2 of this fiscal year. But the amount of easing that you're seeing in terms of policy, in our view, is probably not going to be enough to offset some of the uncertainty-related slowdown or slowness you're going to continue to see on the private investment front. It's not just for India, but also globally. It's difficult to imagine private capacity being set up in an environment where uncertainty is so high. And therefore, the upside that you're going to get from the policy easing is going to be somewhat negated from the uncertainty in our view. The second point on the fiscal is that at the end of the day, even with the tax cuts, you are consolidating the deficit. It's 80 basis points this year. It's going to be 40 basis points in the year after. And when you think of it in terms of the fiscal impulse to growth, which means the change of fiscal policy impacting growth, while you're going to have a small upside from the tax breaks, you're going to take somewhat away from government spending being slower overall, which is the other current expenditure being weaker. And therefore, unless the domestic economy really picks up, we would be in the camp where growth is in the sub 6.5% range.
Fair point. Well, actually, we have to take a quick break, but we will dig a little more into the growth argument and into the more difficult terrain of tariffs in a minute after this break. Welcome back. We've been discussing with three economists where the rupee is headed, current account balance of the country and growth. The range so far that we have is that the rupee this year maximum goes to 89, so the worst of the depreciation is behind us, and that growth is not picking up so much, probably 6.3 to 6.5. I've been speaking with Samiran Chakrabarty, Upasna, Chachra and Santanu Sengupta. Well, Samiran and Santanu had their word on growth. Upasna, where do you stand on GDP growth for Q4 and FY26?
So we are tracking growth for Q4 at around 6.7%. I think we would focus more on the GVA to get a better sense of the underlying growth momentum. And as laid out earlier, the drivers are agri, rural, to an extent pick up in public capex spending, and also some improvement on the services export side that we are seeing. And that should, let growth settle around 6.5%. So for fiscal 26, we see growth around the 6.5% mark, driven by these drivers.
Okay, so we have 6.5, 6.3 and 6.6 as guesses for FY26. But, the sympathies are there for you economists to forecast because there is this big tariff overhang. Give me your best estimate, Santanu, if you all have done any homework. If you look at the tariff numbers, the Indian exports to the US is, about 2% of GDP. So what may be the impact on India's GDP, assuming tariffs go higher?
Yeah, obviously, it's a difficult question. You can think of it in multiple ways. One is country-level reciprocity, if President Trump goes for reciprocal tariffs, or you can look at product-level reciprocity. The range in terms of the weighted average differential that we have calculated has been, between 6.5 to about 11.5%. And then you've got to make the assumptions around what kind of elasticity you assume for your exports. So with these assumptions, we think purely from India's point of view, which you rightly pointed out is 2% in terms of the exports, we think it's going to be between 10 to 30 basis points. So it's not a very significant number. However, if you have multiple countries coming under the reciprocal tariff umbrella, and we're going to figure out what happens on April 2nd, then the impact would be larger because you could have some of your intermediate goods being exported to one country and from there the final good going to the US. And if that country also comes under the tariff umbrella, then your export demand is effectively going to get impacted. Our sense is that it's not just going to be hard tariffs only. You're going to have other bargains along the way, and you can have more of non-tariff, measures. You can have a trade deal, which India has been talking about. Indian officials have been talking about with the US. There could be further more happening on the energy front, and therefore the whole gamut of possibilities are there to finally get to that number, which might look very different by the end of the year compared to what you see in terms of the announcement on April 2nd.
Okay. No, I agree. These numbers help, although I know that there are shifting sands over here. I mean, you may reduce tariffs for the US and you may end up getting flooded with perhaps milk powder from New Zealand or Netherlands. So we really don't know how these things will work. A very quick, if you all can, one sentence answer from all of you. And this is the toughest question. Samiran, your best guess on when capital flows may turn into inflows? Quarter.
We have taken a view that from a quarter sense, the capital account surplus quarter is likely to be Q2 FY26 is when we get into a capital account surplus in the view.
Okay. So July, August, September probably. Shantanu, you want to take a jab?
Same. July, August, September is when we would think. It's too much uncertainty in the April to June quarter.
My sympathies with you. Upasna, what is Morgan Stanley's best guess?
So as I mentioned, probably second half, and I would side with them. Probably the September quarter could give us some indications.
Okay. Even this would be music to the ears of the market and to investors. Samiran, Upasna and Shantanu, thank you very much for giving us a 360-degree perspective of macros and markets and for sticking your neck out in very, very difficult times. We wrap up on Indianomics on that note. Thanks much for watching.